Hi everyone, before I start this video, please have a look at my screen. What you will see is that in both the screens, we are investing 25,000 rupees every month for 30 years. But in screen 1, we are generating 13 crores, almost 14 crores, while in screen 2, we are generating 28 crores, double the money in the 30 years. The difference being, in the screen 1, we are generating annual returns of 14%, while in screen 2, we are generating returns of 17%. So a 3% increment in our mutual fund returns every year is giving us almost double the mutual fund wealth over 30 years of period of time. Please know that it is extremely hard to increase our mutual fund returns by 3%. But if something is extremely difficult or hard, it doesn't mean we shouldn't give it our best. In fact, in this video, I'm going to give my best to give you 5 strategies to increase your mutual fund returns over 30 years. I'm going to give you practical examples and in a very simple language. And if you like this video, please press the like button and you can follow me for upcoming videos. Strategy number 1 is to make tactical moves within your mutual fund portfolio. Without giving you a lot of theoretical gyan, let me give you a simple example. Let us say you invest in equity-based mutual funds or stock-based mutual funds for a long term, 10 years, 20 years. What you need to do is in the short duration, let us say next 6 months or 1 year, are you going to get good returns in equity mutual funds or not is the question you need to ask yourself. And if not, what are the alternative options for the next 6 months to 1 year? This is called a tactical move. Now, if you look at my screen, you will see that in the last 6 months, if you look at liquid fund returns, so from November 2021, liquid funds were roughly giving 3.5% returns annual basis. And if you look at now or January 2023, they have been giving close to 7% returns, right? While if you look at the Nifty, equity-based index funds or mutual funds, Nifty has been performing really flat in the last 6 months. And all of us at certain level knew that the Nifty or the stock market is not going to perform the way it has been performing in 2021 and 2022, right? What we should have done is moved our money into liquid mutual funds for the shorter duration. For the next 6 months or 1 year, we should have parked any SIPs that we were planning to do in the equity mutual funds to liquid mutual funds. Now the obvious question is, you will say that, Rahul, how are we supposed to know all of this? Well, it's very simple. Let me walk you through this. As you can see on my screen, RBI has been constantly increasing the repo rate in the last few months. It started from 4th of May onwards. It was at 4.40%, and in the 3 cycles they got up to 5.90%. And if you look at the liquid fund returns here, from November onwards they started to give better returns. It's very natural. This is a very simple macro explanation. Whenever the repo rates go up, the debt is going to become very lucrative from an investment purpose. People who understood this, they reacted to it and moved their money from equity-based mutual funds to the debt mutual funds such as liquid mutual funds and would have got better returns. Also, I can show you that if you look at the gold returns in the last 1 year, you will see that roughly last year around September-October time frame, gold was trading at 50,000 per 10 grams and now it is trading at 60,000. All of us again knew this signs that recession is coming up, stock market is not going to perform better, and gold is one of the good hedging mechanics when it comes to stock market not doing well. And people who have done the right move tactically to move their money from equity-based mutual funds to gold would have got much better returns. So please understand that the first strategy you need to deploy is the tactical moves. Look at your portfolio, ask yourself the next 6 months or 1 year, what is likely to be the condition for my investments, and based on this you can decide to move your money. And if you do not understand how to read macros, you can also subscribe to my YouTube channel, because more often than not I will bring these type of videos. Strategy number 2 is to adjust your long-term investing strategy. Again, let me give you a very clear example. What you see on my screen is large cap mutual funds performance in the last 1 year, and you will see that only 13% of actively large cap mutual funds have managed to beat the index mutual funds. Right? Now, what this tells us is that should you continue to invest in the large cap mutual funds for next 10 years, 20 years as a long-term strategy, I think you need to take a pause, think hard, look at why this is happening, and based on this you decide whether you want to continue doing the large cap mutual fund investment, or do you want to move to the index mutual funds, which is passively managed mutual funds, or not, right? So the key reason of actively managed large cap mutual funds not able to beat index mutual funds lies into the story of 2017, when SEBI actually recategorized the mutual funds, and they included a clear rule for mutual fund houses that large cap mutual fund investment, they have to make sure mutual fund houses are putting at least 80% of their portfolio into top 100 stocks only. Before 2017, what was happening is a mutual fund house wants to make better returns than index, they were free to choose even the small cap mutual funds or the mid cap mutual funds to generate better alpha. But after 2017, what has happened is SEBI has restricted them. Therefore, the choices that the mutual fund manager has is to only invest 80% of their money into the 100 stocks, top 100 stocks or top 100 large cap mutual funds. So as a result, the choices for the mutual fund house or the manager is very limited. Therefore, they're not able to beat index funds. Is it likely to continue? I think so, because index fund is going to give you better returns than actively managed large cap mutual funds. So it's time for you to potentially consider moving to index mutual funds. Now the question comes, Rahul, what do I do? I'm already investing in a large cap blue chip mutual fund. Should I stop? Should I exit? Should I withdraw? The simple advice I can give you is that please do not withdraw all of your money from large cap mutual funds. Simply stop doing SIP into that. And for the next 6 months, 1 year, 2 years, please start putting your money into the index mutual fund. Compare the returns after 2 years and make a decision for yourself. There are not going to be a huge differences between the index mutual fund or actively large mutual funds, but at least for the next 2 years, you can see the result for yourself, and accordingly, you can adjust your long-term mutual fund strategy. That will give you a lot of savings over a long period of time. So far, if you're liking this video, please press the like button so that this video can reach out to more and more people and more people can get benefited from this video. Let's move to our strategy number 3, which is to ditch underperforming mutual funds from your mutual fund portfolio. Let me give you a very simple example. Have a look at this Axis Blue Chip Mutual Fund direct plan, and you will see in the last 1 year, if you look at the last 1 year period, blue line is Axis Mutual Fund and the orange line is the index returns. You will clearly see that Axis Mutual Fund has not been performing well. I've set up a rule for myself that in the last 4 quarters, if a mutual fund is not able to beat its benchmark index, then it's time to exit that mutual fund. I've created a separate full video on how to exit, when to exit the mutual funds. Please go ahead and watch that video. Very important video. Now coming back to this strategy here, please go ahead and identify such mutual funds that are not performing for you. And what you need to do is plan an exit from those mutual funds. The simple advice I will give you around how to exit mutual funds is never abruptly exit a mutual fund. What you do is you set up a systematic withdrawal plan. Again, I've created a full video on systematic withdrawal plan. It's very simple. Let me summarize in the next 10 seconds. You set up a systematic withdrawal plan and you withdraw all your money, or at least that much money that gives you long-term capital gain of less than 1 lakh rupees, so that you don't need to pay a lot of taxes. And also please try to time it in such a way that you are withdrawing your money from November to April in 1 year, and then from April to next November in the second year, so that in the 12-month of period you can withdraw majority of your money, or the money that is giving you less than 2 lakhs of capital gain, because that will become tax free for you and you will not need to pay any taxes on that. So please consider removing those mutual funds from your portfolio that has not been performing in the last 4 quarters. Strategy number 4 is don't let your money compound. You will now shoot me and say, bullshit Rahul, what has happened to you? Why all of a sudden you are telling us not to let your money compound? Well, hear me out first. The strategy is very simple here. Every year we get 1 lakh rupees of capital gain tax absolutely free from our income tax. And if you have a portfolio of, let us say, 10 lakh rupees, and last year that 10 lakh portfolio gave you 10% returns, that means 1 lakh rupees of capital gain. What you need to do is you have 2 choices. Choice number 1 is you do not withdraw this money, right? So your 11 lakh rupees remains invested in the mutual fund market for the next 10 years or 20 years, earning handsome money for you, doing a lot of compounding for you. Choice number 2 is you withdraw this money every single year, so that 1 lakh rupees that you've gained every year, you don't need to pay any tax on it. But then withdraw it only for 7 days, so that you withdraw the money and you put the money back in the mutual fund market. Let me also give you another example here. Have a look at this SIP plan. Every month you're investing 25,000 rupees at a 12% rate for the next 10 years. At the end of 10 years, you are going to get 58 lakh rupees. But please be aware that in the next 10 years, you have gained capital gain of 28 lakh rupees. At the end of 10th year, you will have to pay income tax on this 28 lakh rupees. And secondly, you can never say what will be the capital gain tax applicable after 10 years. Government might increase this 10% to 20% or 30%. What you should do is every year withdraw that much of capital gain, which is totally tax free. So coming back to this example, if you had withdrawn 10 lakh rupees every year, 1 lakh rupee each, then what is going to happen is your capital gain tax at the end of 10 years will not be 28 lakh rupees. It will only be 18 lakh rupees and you will be paying tax only on 18 lakh rupees, right? So please make sure you do not let your money compound for 7 days every year. Withdraw this money, reap the benefits of capital gain tax and put this money back in the market. So far, if you're liking this video, please press the like button so that it can reach out to more and more people on YouTube. Let's move to strategy number 5, which is to offset your capital gain every year smartly. Let me give you a very quick example. Let us say last year you invested in some of the stocks that have not performed well, likes of Nykaa, Wipro, Infosys, and you've made, let us say, 50,000 rupees of loss. What you should do is redeem your profitable mutual funds that are going to give you capital gain of 1.5 lakh rupees in this example, because this 50,000 rupees of short-term capital gain loss that you've incurred from the stock market, you can offset it against the long-term capital gain that you have generated from your mutual fund portfolio, which in this case to be 1.5 lakh rupees. So 1.5 lakh rupees minus 50,000 remains 1 lakh total long-term capital gain that you've gathered from your mutual fund portfolio, which is totally income tax free. This way you can not only reduce your losses, you can actually save a lot of money in taxes that will give you long-term value in the mutual funds. And the second rule that you need to remember is that you can carry forward your losses for up to 8 years, both short-term and long-term. Again, a very, very important rule that all of us should know. By the way, I have created a full video on capital gain taxes. Please go ahead and watch it. Very, very important video. There are only very few videos out there that summarizes the capital gain taxes in one single video across the stocks, bonds, and gold funds, etc. Please go ahead and watch this video. If you've come thus far in this video, I want to say big thank you to you and a humble request. Please let me know in the comments how did you find this video, and also let me know in the comments the topics you would like me to make videos on. I'll be more than happy to shoot videos on your given topics. I will see you in my next videos. Keep rocking.